All right, in this lesson, we're going to look at LIFO, and we're going to look at it from a very simplistic example. We're just trying to help you understand the mechanics of this. And then in the next lesson, we'll go through a more comprehensive example. So let's take a look at the example problem for this LIFO periodic problem. So company A is a wholesaler who buys machines from a local manufacturer and sells them directly to their customers. Company A has purchased 5 machines to sell for their customers, and the information is shown below. So we've got all of these machines, their costs, and then the date that they were purchased. Notice that we've already put it in order for you. We've got the earliest at the top and then the latest cost that came in at the very bottom. In the month of May, company A sold 2 machines. Those machines were B and D. The question is, what is the cost of goods sold for May, the ending inventory, and the gross profit for the sale of those 2 machines, assuming the LIFO method, and then we'll need to do the journal entry after that. So if we break this down here, we sold B and D, right? But we're not using specific ID. We are using LIFO, so we need to follow that cost flow assumption. LIFO says that we take the latest cost and we assign that to the first unit that was sold. So in this case, we'll assume that unit B was sold first because that goes before D. So if B was sold first and we're using LIFO, then we're going to assign a cost of $17,650 to B. So last one in is the first one that goes out. The last one in was $17,650. That's going to be the first one that goes out. Then we sold D. So again, we go to the next latest cost. Well, the next latest cost going up is $14,350. So we're going to assign D, and it just so happens that that was D's cost, but that's just a coincidence. $14,350. So the 2 costs that we're going to be moving up into the cost of goods sold from inventory would be the $17,650 and the $14,350. So let's go ahead and move on here to calculating the cost of goods sold, ending inventory, and gross profit. So like we said, we sold 2. We start from the bottom and go up. So $17,650, $14,350. And the reason why we can go bottom up is we've organized it from earliest to latest cost, okay, or purchase cost. So that's kind of why I'm going bottoms up. All right, so cost of goods sold here would be $14,350 plus $17,650. And if we add that together, we get $32,000. So our cost of goods sold is $32,000 on those 2 units using the FIFO method. Now moving on to ending inventory, or first of all, let me transfer it from the T account so you can see. So T account 32,000 would be a credit to inventory, debit 32,000 as a debit to cost of goods sold. All right, now we can look at ending inventory. Ending inventory is we're going to take our total inventory, goods available for sale, in this case, $68,950. And we know that because we've already done the math here, and it's also here. So we're going to take that, and we are going to subtract how many units, or the cost of the units that were sold. So in this case, 32,000. So 68,950 minus 32,000 gets us an ending inventory of $36,950. So $36,950. So if we were to add up A, B, and C, those costs, that should give us $36,950. So, yeah, 36, sorry. I was thinking I just said 39, and I was like, that is not 39, but it is 36. So if you add up A, B, and C, that should be 36,950. All right, so that's our ending inventory, 36,950. And now we need our gross profit. Gross profit is our revenues minus expenses. Well, revenues minus our cost of goods sold gives us our gross profit. So our revenues would have been the 18,000, and we sold 2 of them. 18,000 plus 18,000 is $36,000 in sales revenue. Now, we did do our cost of goods sold, so our cost of goods sold was $32,000, so we'll subtract that. And so our gross profit on these units is $4,000. Now, as a side note, if you did the FIFO example, which is the same thing here, you'll notice that the gross profit was higher over there than over here. And that will happen. You're going to have 2 different sets of numbers. So I don't remember exactly what that number was, but it was not $4,000. It was way more than $4,000. So our gross profit is $4,000. Now it's time to do the journal entry. So to do the journal entry, we're going to need to know the sales and the cost. So the sales was $36,000. The cost was $32,000. So let's look at our journal entries here. So to book the sale, we received cash, and how did we receive it? Sales revenue. So we're going to debit cash in the amount of $36,000 and credit sales revenue. Okay, so how do we incur that $36,000 in cash? Because we sold some items, $36,000 worth of items. Then we need to book the cost. So the cost of the goods that the customer took from us, that equated to $32,000. So we're going to move it out of inventory into cost of goods sold. To do that, we'll debit cost of goods sold, and we'll credit inventory for $32,000. And we can see that in our T accounts. If we go back to our T accounts, that's literally what we did to the T accounts. We debited cost of goods sold and credit inventory. So that is a simple mechanic example of a periodic LIFO example. Again, the key with this lesson is just helping you see the mechanics on a very easy example. We're not working with quantity necessarily. We're just working with individual units. But in the next example, we are going to turn it up just a bit and show you a comprehensive example that would happen in the real world when it comes to multiple quantities that we have to deal with and assigning those quantities based on different costs using the LIFO method. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.